The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, welcome to today's webinar. First of all, just to hopefully check everyone can hear me. Hopefully they can. So if you can't, please send through a question and we'll see if we can help you out on that. Although what we will do with questions is we will wait till the end. There is a 15-minute period at the end of the webinar where everyone can ask questions. So anything you answer, we'll try and get through them all. If we do have quite a lot of them, of course it'll be hard to get through everything, but we'll get through what we can and hopefully give you the answers that you need. So what we'll do is we'll get going. Hopefully you can all see my screen and you can hear me, and we can go through there. Thanks. I'm getting the questions through as well, so that's great. And I hear a few of you coming through loud and clear. Perfect. Fantastic. Okay, let's get going. Firstly, my name is James Hughes. I am a Senior Market Analyst here at Alpari, and we will go. We'll start the webinar. It's called Identifying Trading Opportunities. Now, first, a little bit about what we're doing with these webinars. There is a whole set of them, which will be starting off. This is our first one today, Identifying Trading Opportunities. What we will have is 2 per week. So there will be an educational one, and then there will be a weekly market roundup, which will be every Thursday. Now, every Thursday, that one will basically do what it says. It will look at all the major trends that have been going on in the market. Basically, at the moment, talking about the Eurozone, Greece and Italy, I imagine. But we will talk about those major points of what's going on and how things are moving around in the Forex market. What we'll also do throughout a lot of these webinars is give you a few ideas of what's coming new at Alpari, and if there is anything big, we will talk about it from that point of view. So also, if we, again, as I said, just for anyone who's joining later, all questions, we'll try and answer all the questions at the end of the webinar. There's a 15-minute period, so we'll try and get through all your questions then. Okay, so let's get started. Basically, the webinar is called Identifying Trading Opportunities. For the majority of the webinar, we will be looking at the MT4 platform and basically looking through quite a few charts. My approach to trading and approach to when I'm trying to look for things to trade is mainly on a technical level, looking at both fundamentals and technical forms of trading. And of course, we'll cover through quite a lot of basic points on what you should be looking for, what are the main points, and basically when not to trade, because I think that's probably one of a few of the most important points to get to is the fact that sometimes the most profitable trade is when you actually don't place a trade. So not always being in the market, you don't always have to trade. So there's so many points that people will look to, and one of my pet hates about trading, financial markets, education through a lot of brokers is overcomplicating things. I'm a big advocate of keeping things simple, and that is a real key point to what I look for when it comes to technicals, technical indicators, fundamental indicators. Everything is going to be kept on a very simple point, and we'll start from basically a technical level. Technical analysis can be so overcomplicated when you come to oscillators, moving averages, Ichimokus, whichever it is you tend to look for. And of course, there is no right or wrong answer. So that's an important point to realise as well. Some of the points I may show you, you might totally disagree with, you may agree with. But the fantastic thing about trading, when to trade and what to trade, is it is also subjective. So you all have different ideas to me, I'm guessing as well. So let's have a little look to start off with at some technical points. And what we'll do throughout this is I think it's hard to do any kind of webinar at the moment or any seminar, talk to anyone about the markets without mentioning what's going on Eurozone-wise. So towards the end we will have a little bit of a chat about the markets and exactly what's going on. Just checking that everyone can hear me still. Can everyone still hear me? Good. Okay, right, we're fine. This is our first webinar, so you will have to forgive us a few technical issues if we lose sound or things like that, but hopefully we'll keep going. Okay, so what you should see on your screen in front of you is the MT4 platform at the moment. Now, what I'll cover off is a few different points of some of the major levels, and major TA is what we'll start with. Now, technical analysis, it can be pretty much one of those subjects you either love or you hate. You either basically think it's that self-fulfilling prophecy that everyone tends to think half the time. But whether it is that self-fulfilling prophecy or not, if it is self-fulfilling, it still dictates a lot of the time where the market's going to go. So looking towards those major levels tends to be the way that many people look to, and looking at all those levels, we'll go to one chart just on cable and have a look at this one. Now at the moment, markets have been absolutely all over the place. We've seen volatility from pretty much everywhere, and I don't think that's necessarily going to stop towards the end of the year. A lot of people talk about Christmas being a little bit more of a calmer time, and we will see that calm set in at some point. But I think with the Eurozone crisis going on at the moment, whether it's going to be Berlusconi out next or anyone else, then I think we're still going to get this volatility all over the place. And one chart I'll show you, we've got this cable chart up at the moment. We can see this huge amount of volatility throughout the last sort of year and a half or so. But if we just look at the slide, and excuse me, I've had to take this chart from Bloomberg, so hence I can't get it on. But that is the VIX chart. And you can see, and that's a volatility index, and you can see just what this crisis has done to the volatility of these markets from really the end of July, start of August. And you look throughout that, we've pretty much, the VIX is kept below that 25 level for a long time, a spike in March 2011, of course, when we were talking about Eurozone yet again, and then that was a major problem that caused some point of volatility. But just from August, these markets have been totally insane. So that shows you that the opportunities are absolutely everywhere. And what we want from this is what we want from trading, and whether you're trading Forex, stocks, indices, whatever it is, volatility is your friend. And a lot of people tend to shy away from that quite a lot of the times. If you get volatility in the markets, people tend to think, well, I'll bury my head for a little while. And that's all well and good. As we said at the start, sometimes not placing a trade is just as important as placing a trade. But when you've got the VIX doing what this has been doing, hopefully you can see my cursor there as well on the screen, but you've got this unbelievable volatility. You can see it's pretty much unprecedented for much of the year. We haven't really seen anything like this since 2008. And what's been different about this crisis in the Eurozone in terms of how the markets have reacted and what it was like in 2008 during the financial crisis then, was what we saw in 2008, 2009 was markets going heavily lower, getting hit pretty hard, and pretty much everything losing value, whether that be currencies or anything else. What we've seen this time is uncertainty. Now, it's an old cliche, and if you come to any of the other webinars, you will hear me say this all of the time, or if you've ever read any commentary or ever seen me doing the interviews, I say this pretty much all the time. But the markets hate uncertainty, and that is, okay, number one, not great for the markets, but for the trader and the retail trader, that's a fantastic thing. So with this volatility, there are so many opportunities out there, and something which will enable us to really benefit from this is using an oscillator which I like to use quite a lot of time, which is called an RSI. Again, really basic, and we're talking technical analysis, but it's a real basic oscillator. And again, if you're talking about technical analysis, you look to major levels and points like that, and people tend to bury their head in the sand and worry that it's a little bit overcomplicated, and especially when you start to mention oscillators, it tends to become again a little bit more of a struggle. Hold on 2 seconds for me. Sorry, I've got a bit of a cough, so I'm just stopping you from hearing me cough down the mic all the time. So if I go on mute, that's what's happened. So we talk about those oscillators. They are the major oscillator I tend to use is the RSI. It's not necessarily so widely used, and it's not necessarily so widely used when markets are trending. So let's look at a quick chart on the dollar Swiss. Now, everyone knows that dollar Swiss has been doing unbelievable things recently. That is from October last year to October this year, end of October this year, and it's really you can see it was all in the news the whole time, with markets moving higher, the Swiss intervention into their currency. Now, if you were to use the RSI on on this, it wouldn't work basically. RSI is an overbought and oversold indicator. It basically shows you if the market is overbought above a 70% level or oversold below a 30% level. And if we just grab that up and we can show you that on a chart. Below here at the bottom is an RSI. Okay, this is on a euro-dollar chart. It's a daily candlestick chart. And basically you have this line that runs through the middle of it. Now this oscillator is fantastic in markets at the moment. When the VIX has been doing what we've just shown you, then it's an absolutely fantastic indicator to look for. It's so basic that you have these two big levels that everyone looks for, 30% and 70%. Those are the big ones that everyone tends to keep an eye on. Now, the level through the middle, but the basic way to measure it is if the market drops below that 30% level, you have got a buying opportunity bang in there. And again, if we look for this, and there's rule two main things you look for in the RSI. This is the first one: a drop below these levels. Drop below the oversold level gives you an idea that the market is going to bounce higher. And again, if we look at the times that this has done this on the euro-dollar, we've dropped below 30% here, and as you can see, after the big fall lower, we saw a bounce higher. Of course, the other thing that this won't necessarily do is tell you the other way. It won't always fly straight up above 70%, and it won't give you those perfect signals. But of course, what does? So the best way, using risk management tools, using your stops, limits, and just protecting yourself as the market goes. But a drop below 30% here in August, September time, saw market push higher again. Again, this is a bit more of a longer term view, but again, after we got back up to that level, we didn't hit above 70, so that was just your initial point. Not being too greedy, taking your profits out of that one would help. Markets then fell back, another drop below that 30% level, and again we saw this big move back to the upside. So using that RSI is fantastic when the markets do get like this, when they do start to move all over the place. RSIs will be a major point to look out for. And again, this is my whole advocate of keeping things simple. The more you go, the more complicated you go, the more slow, long stochastics you go for, you tend to have a bit more of a problem in overcrowding your charts. And okay, the chart I've got up at the moment does look a little bit overcrowded, but we'll come to a few more of those issues. But when you start getting Ichimoku clouds and different oscillators, you tend to lose the most important part of that, and that is the price action. And of course, half the time, losing the price action out of a chart will not help in any way, shape or form. Hold on 2 seconds for me. Okay, we've got a few sound issues, so I'm sorry if you're not necessarily hearing me so fantastically all the time. I understand it may be cutting out a little bit, so I'm sorry. We'll try and get those sorted out. Okay, so again, so RSIs are that major point, and when markets are like this, it becomes an absolutely ideal thing to look towards. So let's just we'll come back to this cable chart we were talking about, and just looking at these major levels with an RSI as well. So we're going to add an RSI to this cable chart at the same time. So those of you who don't know necessarily you've got the MT4 platforms, whether you've got them up in front of you, but adding these indicators isn't necessarily too difficult. Going to the oscillators and finding the relative strength index, that's what the RSI stands for. So we'll add that in. Usually I tend to use and I've seen a question come through here about the periods. I mean, a 14-day period is the best one to go for. I tend not to change too much stuff around when looking for this. Again, so we've got this daily chart. Again, big, every time we see these drops below this 30% level, it's pretty much like clockwork that we get big moves to the upside. And this was ideal. Of course, we're going back to 2010 here, but it's been a pretty volatile chart for a long time. But drops below 30, above 70, we can see that this basically works like clockwork on these points. But looking at the major levels we were talking about, we've got this level down at around 152.60 or so, and that's been acting as a big support level on the downside. And this is where a lot of people tend to ignore those huge levels, and this is when people tend to think about, oh well, I don't necessarily want to use these points because they're more of a more of this self-fulfilling prophecy situation. Everyone has stops there. Companies are hunting stops out, and we're gonna and we're gonna. I won't necessarily get filled at these points. So there's a lot of worries about those sorts of points. But I think that the big thing to look out for is that these levels do work. There's so much technical analysis that people try and add on that just pretty much doesn't work half the time. If you want to look for things that are going to be regular and that things that are actually just going to work for you, and big levels are the best ways to do that. So of course we've got this level 52, around 52.60 or so. Again, every time we come down there, we're jumping up higher. So again, just keeping things simple, moving this down and moving this down and basically placing your trades with the stop losses, and that's the key point. If you're buying on these big levels, these big drops to the downside around this 52.60 level, is placing those stops. And a key point on this chart we've got here is, if you can see, I've got the Fibonacci retracement levels on there. Now the Fibonacci retracement, I've started from the lows in April 2010, and they go to the highs in April 2011, I think that is. What we've got underneath this big level at 52.60 is the 61.8% retracement level on the Fibonacci. Now, for those of you that don't necessarily use Fibonacci, it is, again, a pretty simple indicator that shows you where those big levels are. Now, how it works and why it works is something for another day, and the origins of Fibonacci go back a long time. And if you were to actually look at a lot of those origins, you would think, how the hell does this relate to financial markets in any way? But again, you'll find that these key levels do work. So within Fibonacci, there's a few key points that you do look for. 61.8% retracement is one of them. 38.2 is another. Now, as you can see, after this big move to the upside, where we stopped, we saw the market fall back down. And again, if you disregard this side of the price action to start off with, but when we went to this low point, 38.2, again, everyone is looking to these levels, these big 38.2, 50%, 61.8% on Fibonacci. Went down like clockwork, bounced back higher. After the break, again, there is a 50% level. Didn't hold around the 50% level, but again, it's because we've got this big level 52.60 at the bottom, which is the red line on your screen. So what we're basically talking about is, if this market does come down there, you're looking to trade with that stop loss just underneath. Now, whether you wait exactly to 52 point, the exact level, which is 52.57, actually 52.57.3, if you're being precise. Whether you're going to wait to that or you're going to wait to round about there is up to you. But of course, what people tend to do, and one big thing with technical analysis, is you have to give it some leeway. If you follow everything to the book, you're never going to place a trade. But if you keep things, give them a little bit of leeway, let things move around a little bit. Don't use exact levels. That's why when I'm saying this level, I'm saying 52.60 instead of 52.57 or 52.57.3. You cannot be too precise. The markets are not will not do what you want them to do all the time. So keeping, especially in FX, keeping things to as strict as every single pip is going to be impossible. So basically what we'll be looking to do is, as this comes down to around your 57.3, you've got a natural place to put your stop loss, which is around this 61.8% level. A break of the big level will be a warning sign, but a break of that 61.8% again is going to give you even more of that signal that this may go the other way. But of course, what we've seen in the past is any move down towards this level has seen a bounce higher. So 52.90 was around where it stopped before, a little bit higher before that. Again, after breaking the 50% and 38.2% levels, we're bouncing higher again. And of course, the Fibonacci only works after this high, of course. But the level, the 52.60 level, has been holding for a lot longer than that. What you also want to do, of course, is use your fundamental data with your technical data. Now, again, this can be hard to do, especially with what you've got in the markets at the moment. It becomes almost an impossible job to keep yourself on side with both of these, and people worry again the self-fulfilling prophecy side of things, and the fact that at the moment this uncertainty basically means that there is no exact points where you can get to or where you can get out of. So it's important to keep both in touch, I think. So from a fundamental point of view at the moment, if you look towards some of the economic calendars, those economic releases, they're the key points that you need to go to. And I think they're the only real point at the moment which will give you any concrete movements or concrete points to trade from a fundamental point of view. Of course, the big stories are the Eurozone, they're Greece, or what's going on out there. But if you just look to last week and what happened with Greece and the Eurozone, it's pretty much impossible for you to look at what's happened last week and try and trade off of it. And you just look at what the markets have done. Pretty much nothing that you could predict. All we saw was you could have predicted the day the referendum was announced in Greece that we would get a big fall in the markets, and that's maybe one you could have ridden down after you've heard the announcement, maybe trade on that from a downside point of view. But of course, this is, if you're looking at stocks or indices, that's nice and easy to do. From a currency point of view, it's not necessarily as easy to go for. However, as the week went on, there was no real clear sign that anything different was happening. We had, yes, there is a referendum. No, there isn't a referendum. Papandreou's leaving. He's not leaving. Whichever way you looked at it, the markets were not reacting in the way they should have. We were steadily going higher, steadily coming lower. You can't react from that point of view. So it's really difficult to gauge anything from that. But one point last week which almost slipped under the radar that people didn't necessarily look towards was that, and this is of course a surprise that people almost ignored it, but was the non-farm payroll figure. We had that key US jobs data out of the US, and the fact that number was getting slightly better. We saw a slight movement down in the overall unemployment rate. We saw a slight movement from non-farm payrolls to the downside. So the fact that slipped under the radar was an absolute ideal point for those who were in the know, keeping an eye on it, and not just drowned out by the whole Greece situation, because you got a slight shot in the arm for US markets. So the dollar again had its movements, and of course the major indices had their movements, especially on the Dow. But again, it's very easy to get overcrowded and overcomplicated in all this. So what we'll do is we'll slip a little bit back to technical analysis, and we'll look at this euro dollar, this first chart that we had up earlier on. Now again, what I've got on here are an RSI, that simple oscillator we were talking about earlier, Fibonacci retracement levels, which we were talking about earlier, and what we've got on here are 3 moving averages. Now, as you can see, a lot of the charts I'm looking at are a bit more longer term. Some of the other webinars that we do, especially the weekly market roundups, we'll be looking at a little bit more shorter term. And technical analysis, of course, does tend to work at that little bit better if you're looking towards a longer time frame. The closer you get into things, and the more you break it down into minutes and minute charts and even hourly charts to some extent, you do tend to lose a little bit, and you tend to create too much noise, which is, of course, what you don't want. So from a moving average point of view, these tend to work brilliantly, and there are 3 key ones again that you always look to put on, and again they're the simple ones that people tend to get on. We've got 100-day, a 50-day, a 50-day, a 100-day, and a 200-day moving average. Now these are the ones that everyone looks to. These are the big moves that you want to keep an eye on. Now they also will act as big support and resistance levels. But the reason we're looking at the moving averages on this one are the crosses that we're looking for. Now, you have 2 things which are called really drastic names, to be honest. You have the what's called a death cross, and you have what's called a golden cross. Now, these crosses are really overplayed within the market, and I'm sure a lot of you will have had the same issues where some people will tell you that we've got there's been a death cross, and this is the end of the world. The markets are all over the place, and we need to and you need to trade. You need to get out of your positions. Now, this stuff is all a little bit dramatic, but they do give you key signs again. So what you're looking for is again, you need to forget about the whole purist side of things, because from a purist point of view, you're looking for the exact science of these moving averages need to cross after a certain amount of price action, after a long trend one way or a long trend the other way. It doesn't necessarily work those ways. You're just looking for crosses in moving averages, and they tend to give you big movements in prices. Whether it's one or the other doesn't necessarily matter so much. And again, you need to clear out the noise somehow from a lot of this this TA. So again, looking here, September 2011. You can see we've got a cross here. We've got a cross of the 50 and the 200 day. Now, not necessarily one that people always look to crossing, because they will again the major things that people look to are the 50 and the 100 day crossing, not necessarily the 50 and the 200, but the 50 and the 200 crossed here, and it gave you, of course, this big signal to the upside. Markets moved pretty high, and again has become that. Put us in quite a nice trend to the upside since the really October time, until probably only about 2 weeks, to be perfectly honest. But still, that move was there. That move was there, and it was a good move that everyone could have seen just by those crosses. So you look to the crosses, wait for a small bit of price action, and then you're able to get in pretty aggressively on these sorts of moves. Now, what I've added on here is the Fibonacci retracements, yet again for quite a small move. Now, the reason I like Fibonacci retracements quite a lot is the fact that you can use them and you can pretty much put them on short-term, longer-term, medium-term moves, daily, hourly charts, whatever you like, and they tend to come up trumps. But one of those points that you have to look for on Fibonacci is you sometimes get crosses of the levels, but you have to wait for the next session. Now, what I mean by that, as you can see, lower level this 4th of October time, top level around probably about the 20th of October or so. Got the move down, aggressive move, and of course we know these are all these aggressive moves, and you'd probably think this is a harder time for you to gauge this price action exactly where it's going to go. So movements are to the upside. Big aggressive move down. Now what we've got here is a break of this 50% level. Now what you look for, you can get breaks of these Fibonacci levels. You can get the breaks, but you look for the next session. Now straight away the next session, I say next session or next candle is basically what I mean. The next time frame. So this is a day, so it is basically a session. So you've got a break here, and to be perfectly honest, in the grand scheme of things, this is a pretty aggressive break of this 50% level. However, we did turn around. The next day turned around straight away, moved higher again. Then, of course, next time we came down, moved higher, a couple of sessions higher. Next one we came down, again, close to that 50% level. So again, you can look to these, and because, as we've been saying throughout, you're not always keeping so close to these to the exact side of things, the exact numbers, looking to be within a pip or 2 pips. You can give it a little bit of leeway. That way you get these trading opportunities. You don't miss out. If you keep things too strict, you will miss out on trading opportunities. So the movement down, again, a break. The next day we came back higher. That's a key signal that the next time we come down to around here, this 50% retracement level, that we'll be looking to trade and looking to move higher. And again, this is a little bit of a shorter term move. We're only looking over a daily chart, of course, but we're looking a little bit more tighter in. And you've also got narrowing price action in here as well, with this 50% moving average, keeping us to the upside as well and capping those moves, because as we're going down, the moves are nowhere near as big. So again, key to look out for, key to keep an eye on if these moving averages are doing that. Now, there's one more point I want to show you about these moving averages. Oh, sorry, just to keep back on that Fibonacci again. Of course, you've got this 50% level. The market moved down. The next key level is the 61.8 yet again. So again, that within Fibonacci is the key number, that 61.8% retracement level. So where it is, you can then drop back in and look towards that. Okay, so there is one more I want to show you with this with these moving averages. Oh, sorry, and we'll look at this dollar Swiss chart as well at the moment. And this is, again, this is an hourly chart, so this is a little bit more shorter time. It's great for on the RSI. This takes us back. Sorry for chopping and changing a little bit, but we've got 2 big levels here that we're looking at. Downside level 87.60, and then a shorter term level here around 89.40. Now, what we've also got down here is the RSI, so another key signal that these markets are moving. Again, a big break above 70, markets move lower. You've got the sideways price action. Nothing necessarily that told us that we were oversold, but again, market came up, broke through this 70% level, movement to the downside. And again, this was a slight touch. This again, if you were putting your EAs into here, or if you were studying the RSI, if you'd back tested it in the past, that would just about give you a signal. Be very touch and go though, but again, a nice big move to the downside. And at the moment, we've got this falling lower around this big support level on the downside. And again, a break of that downside support level will most probably take us down to this 30% level. Now, there's one more I want to show you with the moving averages, and it's this one on cable. It's a 30-minute chart. We've got the 50-day moving average and 100-day moving average. Now, the way you can tell this too, I know on MT4 you don't necessarily see the numbers on them, but of course you're looking for the smoother one is the 100-day, the more choppy one is the shorter day moving average. So again, you've got the 50-day moving average as the red line, and at the moment acting as that degree of support. So it almost works as this floating trend line in a way. Now we know what the other trend line looks like, and again I'll get you back up this dollar Swiss chart. That was key, fantastic textbook moves, 3 touches, key trend lines. Broken, but still being held on by that support level. Again, go back to MT4. This is our more sliding version of the trend line, but of course it is still acting exactly the same. So a movement down towards here. Again, you need to give it leeway. You can't just look for these key every single pip that counting. Of course, you need to give it that bit of time. But again, on the downside, holding up. Slight breaks, you will get slight breaks of these levels. And this is, again, whereas nothing is an exact science within this. You will get small breaks, you will get breaks all over the place. So you have to be a little bit more careful in terms of these. But again, movements down, coming to the upside and bouncing back up off the top. Now, that mainly covers the technical side, and that from a looking for trading opportunities point of view, and at the moment it's increasingly difficult to use fundamentals and use technicals at the same time, because the fundamentals are skewed all over the place at the moment with what's going on in the Eurozone and what's going on and what's going on in the Eurozone and what's likely to carry on in the global economies. Now, you look towards the UK and sterling, as a lot of people have been doing, as maybe one of the prettier of the ugly sisters at the moment. You've got some real ugly currencies out there which are moving all over the place. The euro, of course, has been pretty ugly. The dollar's been pretty ugly, but the pound hasn't necessarily looked as ugly as all of those others. So, but again, the UK has got its own economic issues that aren't necessarily going to let up at all. So it's really hard to marry those fundamentals together. But the key points that do keep you in touch are these economic bits of data. Keep an eye on those bits of data. That if things like the payrolls last week can get brushed under the carpet, then there are definitely ways that we can keep an eye on those fundamental pieces of data, keep an eye on that economic calendar, and really use these to go with. I mean, today was another prime example. You had industrial production numbers, manufacturing production numbers, again, which tend to slip under the major radar of what people are looking for. So if you can keep an eye on those, that is when you can marry the two together. You can use these technical points which are being created by the volatility and uncertainty surrounding the Eurozone, and then add in the fact that you've got some key economic data out and use those levels to your advantage. And that's where it will really, really help you out. If you try and trade on the back of this Greek issue and this Eurozone issue, it will do nothing but end up in tears. So using the volatility, yes, but looking closer in terms of your news flow. Even quite a lot of these corporate data. I know we're not necessarily looking at shares or indices, but the corporate news, the fact that we've had such fantastic earnings from a lot of these companies. The UK we're still running today is again another prime example of that. We've got some real strong performances in a lot of corporate news. So economies may be struggling, but there's a lot of these corporates which are doing particularly well. So again, that gives us these ideal opportunities and slight hints that these markets are going to the upside. Okay, so we've done about 35 minutes or so. So what we will do is I'll give me just a couple of minutes to have a little look through your questions to see if we can get any answer a few of them for you. So I'm just going to pop you on mute for about half a minute. Hold on 2 seconds. And of course, if anyone does have any more questions, please bang them through, and we'll try and have a little look. A lot of people are asking what sort of periods are used on the RSI quite a lot of the time. Again, that 14-day period, again, and because I'm such an advocate of keeping these things simple, I think using that 14-day period, which is the general setting that the majority of RSIs will be set to, is the best way to go. Quite a lot of people tend to, with RSIs, they tend to change the 70 and 30% levels as well. Now, I think that can be a little bit dangerous. And again, the reason people do this is because they want to get out of that way of this self-fulfilling prophecy, with a lot of stops being above that 70% level, a lot of pending orders being around that sort of time. It's really, really tough for people to maybe move them. So you tend to, some people move them up 75 and 80% levels and 20 and 25% levels on the downside. I don't necessarily think you do. What you can do by doing that is get rid of quite a lot of the false signals, and false signals are a problem whenever you're looking at any form of TA. False signals do give you a lot of problems when you go forward, and there's nothing you can necessarily do about them, which is why not placing a trade is sometimes as good as using a trade, as placing a trade. So again, it is all a matter of preference, and the great thing about TA or anything like this is there is no right or wrong answer. So it's key that that you basically make your own decisions and just listen to what's going on. I mean, majority of questions that we're getting here are RSIs. Again, a lot is to do with this. To do with these. What sort of periods would you use? Other forms of oscillator to use, yeah, stochastics is one of those you would use, and someone has asked, isn't stochastics basically the same thing? Basically, yes. Basically, they are the sort of same thing. But what you're looking for on stochastics, and what you can look for on RSI as well, is the deviation in the two. That's exactly that's a way you can differentiate the two when you're getting movements in a price action which isn't necessarily showed up on the RSI. If you do get those, then that gives you quite a few signals. But what you can do is find yourself looking too in depth onto quite a lot of things, and really clouding your judgment. And this is what I worry about when I use TA, is that I don't want to get myself bogged down in these points. I don't want to do too much and miss out on other opportunities. So I think that's sometimes a key point to look out for, is just to not necessarily cloud your judgment with all of these points. Okay, bear with me just 2 seconds. Let me see if we can get through any of the other questions from here. See if we've got any more. Okay, we don't seem to have too many other questions running through here. Just a quick, again, reminder of these other webinars that we've got going on. Now, if you're listening from the UK or listening from the US, you've got a couple of different options as to where you would register for these. Again, just go to the major Alpari website, the UK website. It's down the bottom here. Register for the free websites, then that will give you the list of everything that's coming up. So on Thursday we've got the weekly market roundup. Now that is going to be, again, pretty much the same as what we were, as we said earlier, that this is going to look at all the major movements. Now we won't just look currencies. We'll look at, obviously, currencies are what you will be trading mainly, but of course currencies aren't the only asset class in the world, and other things like indices, commodities, stocks, they do move currencies. So it's important that we keep abreast of all of those points. But there are 2 webinars per week up until the start of December or so. So you can please register for any more. And keep yourself into these weekly market roundup webinars as well, because these will be great for keeping abreast of exactly what's going on. And what we'll try and do within those is decipher exactly where these markets are going, and try and maybe get a little bit more of an idea of what the next steps are. But of course, we don't necessarily know, and I don't think half the people in Europe know either. So we'll try not to tell them what to do. But please keep an eye on those. Of course, there is a registered button on the side of these, so go to them, register for the webinars, exactly the same as what you did for this, and we will and we'll get you'll be registered to turn up exactly the same as this one. Thank you for listening to today's webinar. Hope to see you soon as well. So please, if you can come to the other ones, please register. But thank you very much indeed. If you do again want to have any questions you don't want to mention here, you can email me. So you can email me at jhughes@alpari.co.uk. I'm more than happy to answer any questions you do have. If you don't want to say them here and you want a more personal answer, then by all means email me. It's jhughes@alpari.co.uk. Thank you very much for listening, and see you next time.